One of the most important decisions we all have to make at some point in our lives is what we're going to do with the money we earn and how we prepare for the future ahead of us. And so in today's session, I'm going to be talking about an introduction to investing. I'm going to keep it very simple, and I hope that its simplicity does not distract you from its importance. I believe that if you understand the foundation of what I'm going to be sharing, then it's very, very possible that you can very quickly chart your own financial course or path towards freedom, independence, and abundance. I'm going to stop and just talk about just 3 words that I ended the last statement or sentence with. Independence, freedom. I'm going to put another word, security, and abundance. So 4 words. And each of those words are not the same. Financial freedom is slightly different from financial independence. Financial independence is slightly different from financial security. And financial security is different from financial abundance. All of them are mutually inclusive in itself. All of them are different. If you have financial abundance, then it means you have all the 4 combined. Because to get to abundance, it means, number 1, that you have independence. And secondly, you have freedom. And then you have security. It's possible to achieve financial security, but not be financially free. And the reason is because security and freedom are not the same. Just in the same way that independence and freedom are not the same. So you can be independent, but not financially, secure against all potential scenarios. And let me put it in an interesting way so you get it. Let's assume that you have an annual expense of £10 annually, and you're able to secure or build up a nest egg of investments that pays you £10 annually. Once you achieve that, then technically you've arrived at a place whereby you have some level of financial freedom. You're a little bit free, but your freedom is so thin because if for any reason, either due to emergencies or catastrophic issues, your expenses goes up to 15, but your income from your investment stays at 10, then you're no longer financially secure, and you're no longer financially free, and you're not independent. So the key thing to understand is, firstly, you want to achieve a level of financial security. And that simply means that you might have some savings in the bank. I'll talk about this in a short while. Once you've achieved some form of security, that doesn't mean you're financially free. It just means you have some security that if something goes wrong, you're not stuck. Secondly, once you've achieved security, the next level you want to try and achieve is get to a point where you say, I am financially free. Meaning that I have more income through passive and leveraged sources that exceeds my outgoings or my expenses. In other words, you don't have to work to earn. Money comes in through investments. Once you've achieved freedom, the key then with financial freedom is that you have to start increasing the level of your financial freedom because we measure it in a numerical form. There's something called your wealth ratio. Again, I'll talk about that shortly. But the first thing you want to do is get some financial security. Then you go to financial freedom, and then you go to financial independence. Now, financial independence is where you get to a level whereby you've so successfully secured yourself that you have multiple sources of passive income streams. If one fails, the others can successfully cater for your needs. And that, what I call redundancy or margin of safety is such that it gives you some flexibility. So you're independent, meaning you can live the way you want to live, but it doesn't mean that you have enough for everyone. Now, financial abundance is where you get to the point where all of your needs are met, both necessities and both your wants, both your luxury needs. And in addition to that, you're able to provide for anyone else that you so choose to. So effectively, it's where you get to a point where you have much more money than you can spend in your lifetime. And you get to a point where that amount exceeds what your maybe family might require, or what your second generation family would even need. That is where we say you're financially abundant, meaning you're rich. Now let's take a few steps backwards. And I like to go all the way back to the beginning. I've given you a lot of definitions, and I hope that has somehow set the context, because you have to decide how you want to start. In beginning the journey towards financial freedom, independence, security, and abundance, you have to make a choice. The choice you must make is you have to decide whether you're going to become an active investor or a passive investor. And the reason you have to make that choice is simply because you cannot save your way to wealth. Saving is an obsolete strategy for creating wealth. And part of the reason why it's obsolete, and part of the reason why it no longer works, is simply because we have something called inflation. And inflation occurs when the cost of goods and services increases. As the cost of goods and services increase, it means that the purchasing power of a currency is weakened. So, for example, the inflation rate in the UK today is 2%. That means that every year, it means by the start of the year, let's assume that to be January the 1st, by the time you get to December the 31st, if you had money in currency form, you've lost 2% of the value of that money in terms of purchasing power. So saving is a very obsolete strategy to creating wealth, because it loses its value, especially in a country whereby money is being printed regularly. So another reason why you have inflation is, imagine you have £100 and it's in your bank account, but the government decides that it needs to boost or stimulate the economy, and so it decides we're going to print some extra money and put it into circulation so that people can engage in transactions, so people can trade, because maybe the economy is such that people are not spending, people are saving, and the government needs transactions between buyers and sellers to go on. So the government will stimulate the economy by printing money. When the government prints money, it means that whatever you had in your bank account, that being £100, is devalued because you have more in circulation than what was there previously. So saving, I would like you to put it aside as an active means or measure towards financial freedom. You have to become an investor. You save passively so that you can invest actively. Now say that again. You save passively so that you can invest actively. And what do I mean by passive saving? Well, passive saving is saving that goes beyond 12 months, as far as I'm concerned. And I know you have to work this out in your way. Everyone has to, in a way, carry their own cross. But I believe if you hold money for more than 12 months, that's active saving. 12 months is a good time. But what you have to do is find places whereby you can redirect what you're saving after 12 months so that you're getting a return on your investments. For example, if you save in the bank pays you right now 0.25%. So it's almost next to nothing. In addition to that, you're taxed on your savings, whatever interest you gain from that savings. So the whole process of saving doesn't make sense. Now, if you're losing 2% every year and you're getting 0.25% from the bank, it's almost, if you add both, approximately, you're still losing about 2%. So what you have to do is find an investment opportunity that pays you at least 2%, so that you're at least breaking even. You're back to ground zero. That is the starting point. To do that effectively, you need to invest. To do that effectively, you need to invest. And the reason you want to do it is because in addition to inflation, the cost of living is going up. So you have to allow for some additional adjustments. So the first thing you have to do is understand investing. Before you begin the whole process of investing, I like to suggest to people normally to do an inventory, a personal inventory. That personal inventory begins with asking yourself a few questions. Number one, what skills and what knowledge do you have within the area of investing that would allow you to know what to do intelligently? That's very important, because the most important part of investing is understanding what we call your circle of competence, understanding what you know and what you're good at. The most important part of investing is defining your area of competence. As a matter of fact, before you invest, you've got to become a specialist if you're going to do it actively. And by being a specialist, it means you have to become very knowledgeable. Otherwise, you're playing a game whereby it ends tragically. So I usually say that investing is a zero-sum game. Whenever you have an investment, either buying or selling or transaction, one person is either selling, thinking it's going to go down, and the other buying, thinking it's going to go up. And one of you is always wrong. To be on the winning side, you must have more knowledge, more information, more understanding than the other person. And that means you have to become a specialist. You have to become focused, studying, investing, and what you will be investing in. So the first thing you must do when you do your personal inventory is ask yourself a question. Am I competent? Do I have any particular skills? Do I have any particular knowledge? Do I have any particular talent within this area of competence, within this investment category? The second question you have to ask yourself is, how much time am I willing to dedicate to learn this art of investing? How much time on a daily basis, on a weekly basis, on a monthly basis, on an annual basis am I willing to commit? Once you've done both, the analysis of your skills, the analysis of your time, the next thing you must focus on is being very truthful and frank with yourself. If you don't have the skills and you're not willing to develop and invest the time needed to develop the skills, then you cannot be an active investor. It's really simple, because you'll be playing in a game and you'll be an amateur playing against professionals. And if you play in a game where you're an amateur against professionals, in many cases it's going to be very painful. Your loss is almost inevitable. But in addition to that, you wouldn't know the rules of the game. And that means you can't adapt, change, alter the game to your advantage. The other side will win. So once you've identified that you don't have the time and you don't have the skills, you have to accept that you will be what we call a passive investor. There's nothing wrong with being a passive investor, I have to say. It means that you do not have the inclination or the passion to bring the level of intensity required to learn the art and to play the game regularly. If, on the other hand, you've done your personal inventory and you've identified that you indeed have the appetite to learn the skills and gather the knowledge, and you are willing to make the time, then you might want to become what we call an active investor. Perhaps maybe not even an active investor fully, but maybe you might become what we call more of an enterprising investor, someone who is willing to develop, learn, get the wisdom and the understanding needed to play the game. Once you've done both, then it's a matter of choosing where to begin. I would say one of the things you have to decide first of all is what asset class you're going to invest in. What asset class you're going to invest in. So I'll give you a few examples. The different asset classes. You have what we call real assets. Real assets will be the likes of land and property, or commodities. You have digital assets, which would be the likes of digital currencies. In addition to that, you have currency assets, and you also have businesses. So you can choose. There's so many asset classes you can choose from. These are the four main areas that you can choose to invest in. You can invest in a business. You can invest in real assets, properties, land, or you can invest in commodities. You can also invest in digital assets, as you choose, or you can invest in currencies. And each of those have their advantages and their limitations. The skill set needed in each is slightly different. The fundamentals are very similar, but the skill set needed to excel and to do it really well is slightly different. You have to learn the art. So the next question is, am I willing to invest the time needed to become proficient in all of those? I believe personally that you do not need to understand the technical detail of every single asset class. You just simply need to have a fundamental understanding and choose the asset classes that you believe are right for you, and then develop the skills and the understanding within those particular asset types, and then make your selection and your decisions strategically and intelligently. The reason you want to understand, now I'm going to go back a little bit because I should have said something that I think is very important. In addition to the commodity currencies, you also have what we call bonds. Bonds. A bond is simply a debt security. A stock is an equity security, and I'll explain some of these perhaps as we go along. So included in the asset classes, I should have said bonds. So you have stocks, which are companies, or parts of companies. You have bonds. You have real assets in terms of property or real estate or land. You also have commodities. You have currencies. Now, the reason you want to understand asset classes is because it would help you decide which is right for you. I talked about the importance of the time you have to invest. Very closely correlated to time is your age. Your age. And this is the reason why I think it's very important. Every one of us, we go through phases in our journey towards financial freedom. You're either in what we call the wealth building phase or creation phase. And once you've gone past that phase, you go into what we call the wealth protection phase. So for example, if you're young and you're active and you're working, you earn an income. At that point in time, you're creating wealth. You're in the wealth creation or the building phase. When you've worked for a number of years, and let's say you get to the age of roughly about 55, at that point, based on the standard age of retirement, which is 65, depending on the country you live in, you're now in a category we call protection, meaning all the wealth you've built, you want to now preserve it. You're in the preservation phase. And the reason is because you cannot afford to lose all of what you spend your lifetime trying to accumulate. If you're 25 or 26, you can invest and lose all of your money, but you still have 40 plus years to make it all back. If you're 55 and you lose all of what you've invested and what you built over the course of your life, you only have 10 years or thereabouts to accumulate what took you 40 years or close to 40 years to accumulate, to achieve. So you've got to be very frank. Your investment approach and the type of assets you select has to be somewhat tailored to your age. I know everyone has a level of risk aversion, a tolerance to risk. I have seen people who are in their 50s who are still very open to taking large risks. I've seen people who are young who have no inclination to take risks. So you have to tailor your approach to your age, recognizing when you should be accumulating or when you should be preserving, and even more importantly, when you should be doing both. So I'll give you some overview of what I mean by this. If you're in your early 20s, early 30s, you're at a stage whereby it's not a bad idea to invest more in things such as real estate, stocks, commodities, and to invest less in bonds. When you approach your 50s, 55, the risk is much higher. You can't afford to take the risk of loss. So you might move your portfolio to bonds and real estate, actively managed real estate. So it's about getting that balance. And normally the ratio should be something in the region of, say, 65-35 if you're accumulating. So 65 meaning you're putting money into active opportunities with higher risks, such as stocks, such as commodities, such as property. But as you move into the wealth preservation stage, you reduce the amount that you have in those active assets. So you reduce down to 35% for stocks and property and currencies, and you increase your bonds to maybe 65 because it's a little bit safe. And you choose the right bonds, for example, government bonds, which is they pay you back a lower interest, but they guarantee security on your principal. The whole point of all of this is to try and remain consistent with the definition of the word investing. And let me explain what investing means. Investing means putting money out into perhaps an asset, an opportunity, to be certain of making more money back in return. And you want 3 questions answered. Number 1, is there going to be security on my principal? In other words, if I put my money into this investment opportunity, am I secure? Is the principal secure? The reason you ask that question is because the first rule of investing is never lose money. The second rule of investing is never forget rule number 1. So you want to ask, is this a secure investment opportunity? Number 2, question is, what is going to be the return on this opportunity or risk that I'm taking? In other words, what is the yield? What is the return on capital? You want that to be reasonable for taking the risk. Number 3, you want to understand how quickly you can get your money back. And what is the level of risk associated with getting that back safely? And what is the level of certainty that you might get it? So if you can answer those 3 questions, then we say you're engaging in an investment opportunity. You want the risks to be reasonable. You want to mitigate them so that they're low. You want to go for what we call asymmetric risk review. So rather than say high risk, high reward, you want to say low risk, high reward. That is investing. Anything other than that is speculation. And speculation is simply when you invest with your emotions, or when you invest knowing the risk is very high, but you're hoping, and that's the word hope, that you might make a big buck. Investing should be done based on fundamental principles. And fundamental principles require you to sit back and do technical or detailed analysis before you dedicate money into an opportunity. Because number 1, you don't want to lose money. And number 2, you don't want to forget the first rule, which is don't lose money. Now, once you've understood all of these, then you can start thinking about what portfolio you're going to have and how you can thoughtfully construct the portfolio. One of the most important secrets to success in investing is having a thoughtful portfolio construction. Most people will allocate their money based on asset allocation. On the other hand, you should allocate your money based on risk allocation. I'll give you a good example of what I mean by that. Let's say you have £10 to invest. You can't put 65% in stocks and 35% in bonds. That is not a balanced portfolio. That is not a thoughtfully constructed portfolio. And the reason is because the risk of stocks and bonds are not equal. Very, very different. They're not equal at all. So you have to, what we call, make it weighted so that you're allocating based on risk as opposed to based on money. So rather than say, I'm going to put £6 in stocks or £6.50 in stocks and £3.50 in bonds. No, you allocate the money based on the risk profile. When you've done that, you can then go into what we call the buckets. A bucket could be, you might say, I'm going to invest in companies, and these companies will be in a particular industry, or I'm going to invest in property, and it's going to be residential, or it's going to be commercial. But you can then go further down and select the investment buckets or vehicles of choice. That is how you begin your investment journey. In the short time we have, I can't maybe go much further than that, but I'll try and recap what I've said so far today. Number one, to invest. If you're going to create wealth, you've got to decide, what are you investing for? Financial security, financial freedom? Are you investing for financial independence or financial abundance? Each of those paths has a different level of requirement from you. It needs a level of sacrifice from you. Once you've done that, you have to do a personal inventory. Look at your time. Look at your personal attributes. Do you have the skills, the knowledge, the passion, the patience to learn how to be a good investor? If you don't, and you don't have the time to invest to learn, and you don't want to, you don't have a passion for learning about investing, then you have no choice but to become a passive investor. By becoming a passive investor, you have to then select and choose people, companies that will actively manage your investments for you. For example, you might decide, rather than get a stock mutual fund manager to manage your funds for you, you might decide, which is my recommendation, to go for an index fund. Rather than select a bond fund manager to select your bonds for you, you might decide to go find an index bond fund, which is my preference as well. So it's all about choosing and knowing what to do and having the intelligence. Now, I can't explain why, but I'll say this. In the past 30 years, actively managed funds have underperformed index funds. Index fund simply is a fund where you have a composition of all the stocks on a particular index, and it's effectively is weighted equally. So you just select every fund in the index and you buy a piece of each and every one of them. So it's effectively having a piece of all of the companies rather than specifically going for a managed fund where a manager selects specific funds, so selects specific companies or stocks. So index funds are better if you're going to be a passive investor. That's a choice you have to make. Now, if you want to be an active investor and you've committed to bring in some level of intensity to the game, one of the things you have to do is learn the art of investing. It is an art. Wealth creation is a science. Investing is an art. But success in investing is a craft. I'm going to say that again. Wealth is a science. There are specific principles and laws of wealth. If you obey them, if you understand them, you can get the same results. Investing is an art. It requires thinking, critical thinking. We all think differently. It requires ability to combine psychology and your ability to manage your emotions intelligently, but combine that with economics, because investing is the intersection between psychology and economics. So it's an art. It requires negotiation, it requires thinking, it requires finesse, it requires being able to control your emotions. And so it's an art. Everyone does it differently. However, to succeed in investing, it's a craft. A craft simply means you get better by doing. So if you go to a chef who makes a good dish, cooking is a craft. You can learn everything you want to learn about cooking, but until you start putting the ingredients in, you don't get better. So with investing, you get better by performing, by getting and trying. Now, once you've decided to be an active investor, the next thing you simply have to do is decide what asset class you're going to go into. Are you going to go for stocks, companies? Are you going to invest in bonds? Are you going to invest in real assets such as real estate or property? Or are you going to invest in commodities? Or even, would you go for digital assets, digital currencies? You make your choice, then you have to then construct a portfolio, which will be a combination of some of these assets and choosing the right one for you. But now assigning the funds you have available based on what I call a risk assessment approach. So if you have £10, rather than allocate it evenly across all the assets in your portfolio, you allocate it based on a weighting factor, based on the risk that each of those assets pose. Commodities have high risks. The risk of commodities is not the same as companies. So that is a simple way to begin your investment journey. Now, I hope that's been useful. I hope it hasn't been too quick. I hope it's been simple. But I would encourage you to do something. If you have an interest in investing, and if you have an interest in a better future, take some time and start learning and start studying financial information.